Hey, good evening, everyone. Marty Mazora here, the 18th of August, 2020. Received a couple requests lately for more videos, and I haven't been doing as many of late. Don't always get a ton of hits on the video. Last couple we did, and then again, a couple people in conversations lately said, "Hey, why don't you do more of those? I like those." So, thought about that as I was going through my evening routine this evening. So I want to share some of my findings with you. Then I want to revisit an old chart. It's one you see on your screen there with several data points and look at the market a bit from a technical perspective. We haven't done that as much lately as we have in the past. But first, just kind of a narrative. The market, depending on which index you look at, the Dow was down a bit today, but the S&P was up. NASDAQ was up, I believe, like 1%. Sectors were up and down, depending on which ones you look at. Commodities, with the exception of ag, had a good day today again. Dollar got hammered again. And so it's interesting dynamics that we have out there. Volume has been very weak. I want to talk a little bit about that, which means liquidity is light in the market, which isn't unusual in the summertime, a little more than usual right now. And at these lofty levels, that's a dangerous factor to factor in. Markets move a bunch when there's a lack of liquidity, and they can move a bunch in either direction. So folks, we've got a lot going on in the macro scene. We are still experiencing the worst recession since the Great Depression, far and away. However, as a client mentioned to me yesterday, he had heard that someone predicted that we are about to leave the recession, and he kind of said that with tongue in cheek. And I responded, by definition, that's true. You put I think it's 2 quarters back to back by the old definition of GDP growth, and you're out of a recession. Now, the National Bureau of Economic Research is the official arbiter of recessions. They'll tell us when we're in and when we're out of one. Ironically, officially, we entered a recession before we even had the COVID lockdown, which is consistent with our assessment of conditions all the way back to late last summer. Remember when we began hedging portfolios without really changing the mix dramatically to our core? It was because our economic assessment rolled over and said probabilities going forward were favoring recession over expansion at some point in the relatively near to intermediate term, which makes stocks a risky place to be. So that was actually accelerating into the end of last year, which is when we really mixed up our portfolio. That's when we first entered gold as a core position, and we've expanded on that and the commodity space in general. And that's when we went more into staples and utilities and so on. And that's where we remain today, is with a hedged portfolio with a put option and with an overweighting to defensive sectors, although we have added to material stocks. I believe they are third in terms of weighting size right now. And then commodities, which work well in a weaker dollar environment. I'm going to show you just a little bit of what I run through at the end of the day and make a quick comment there, and then we'll play with this chart for a couple of minutes and I'll let you go. So this page right here is just kind of, I title it Market Scripts, so I usually make some notes above this, but here is just a quick down and dirty daily credit market analysis. And this currency swaps, that's where foreign entities come to swap foreign currencies for dollars. And the Fed has been instrumental in calming down credit markets by making these just absolutely wide open. And they want to essentially keep the dollar at bay. There's no ifs, ands, or buts about it. I wrote an article recently, I think I titled it The Narrow Road Out. A strong dollar, a strong trending dollar would be globally, I'm going to say disastrous, and that may sound alarming, but I believe that's the case when I look at the makeup, if you will, of dollar-denominated debt throughout the world. But so we paid close attention to that. That had gotten real easy. It's got a little tighter. BIZD is an ETF that tracks business development funds. So by definition, you know where they invest. That's actually contracted a bit here of late. So it went from amber to red today. Leveraged loan index, it also has gotten a little less, but minus 4.3 in this environment is amazing in terms of the loss on the year. It was down much more than that, as you can imagine, before the Fed stepped in and started buying junk bonds. PSP, private equity ETF, only down 11.81%. I say that seriously, only down 11.81. It should be an unmitigated disaster were it not for the Fed stepping in. The high yield growth ETF basically is the most popular junk bond ETF, which the Fed can now buy. It's come way back off the depths. I've had to color that green. The muni treasury spread, interestingly, actually rose today, noticeably. It basically denotes higher risk in the muni bond market. High yield spread has been backing up a bit of late. It was green. It's now yellow. 495 basis points, or 4.95%, separates 10-year junk bonds from 10-year treasuries. More junk bond spreads. Credit default swaps still remain tame, meaning the cost of insuring investment grade bonds. That index really spiked, of course, a few months ago. It's come back down. Our own financial stress index has moved to the green. So credit spreads and so forth suggests that the big tightening credit conditions, liquidity conditions that were somewhat constrictive, those are definitely not there. I think there's a tremendous amount of financial stress in the system, but it's not showing up in the credit spreads, which is pretty much what makes up most of this index here. So keeping a close eye on that, we realize that there's a lot of money printing that has made this calm down. And that's not a bad thing necessarily under times like these. It doesn't solve the solvency issues, as I keep preaching about. It does solve the liquidity issue, at least for the time being. Now, stock market breadth and volume statistics, they have been concerning. Today was just a prime example, and so was yesterday. But we had a day where the S&P was up 23 bips, and I mentioned that the NASDAQ was up 3 or 4 times that. Volume was 9% below yesterday, which was a down day in terms of volume, 17% below the 5-day average, 22% below the 10-day average, 25% below the 20-day average. Folks, that just denotes lack of conviction, right? So you have an up day, but really nobody's buying it. It's not that there's been a rush of buyers. There are a few buyers and reluctant sellers that helped the price go up. Staples actually had above average volume on a 20-day average basis of 8%, and they were up 1/3%. Industrials had incredibly low volume, 41% below their 20-day average. They were down 0.5%. The reason that's not red is because clearly if there's only 41% below average, this is not a big panicky sell that brought industrials down 0.5%. So again, the market was up today. New York Stock Exchange, up-down volume was nearly 2-to-1 down, right? So down volume, literally almost 2-to-1, surpassed up volume today on the tape. Advanced decline on the S&P that was up. 334 decliners against 169 advancers. Again, terrible breath. You'd think the market would be down a bunch on a day like that. NASDAQ on a big up day, 1766 decline versus 917 advancers. What does that mean? Very narrow market, very narrow rally today. Nothing at all inspirational in terms of, if you're wanting to characterize current conditions as bull market conditions. We did get 6% of the S&P 500 hitting 52-week highs, 31. None of them hit 52-week lows. For the first time in a while, we actually had some NASDAQ members hit 52-week lows, 15 in fact, against 68 new highs. The 200-day moving average, the percentage of S&P 500 members that are above that has been in the green lately, above 60%. Between 50 and 60, I consider that neutral. Below 50, and that's bearish. So for less than half of the stocks in the NASDAQ, which is way into all-time high territory, are actually trading above their 200-day moving average. That is not a bullish sign from a breadth standpoint. Moving average convergence divergence, which we're going to chart here in a second, on the S&P 500, on the individual positions, 13 buys against 34 sells. That's a loss of momentum. On the NASDAQ, 20 buy signals against 28 sell signals. So folks, this is not a healthy looking market. Now, this is just today, but some of these indicators like these are, they basically are not just a daily indicator. So yeah, if you wonder why, I've got kind of this bearish tone to all my commentary, of course, it's more about the macro, which we really hit hard here, and I share a lot of that with you. But it's also the internals. The internals are just uninspiring right here and have me, or I should say, keep my concerns alive. So this chart, this is a chart that I actually developed way back when the S&P was at 2,600 back, when we were dealing with, the market back in here. You can see when the S&P was at 2,500 back in 2018. Did a lot of videos back then. So just want to go back to the things we were looking at then and kind of address those indicators with what we see now. So upward sloping wedge patterns are bearish. Downward sloping wedge patterns are bullish. So you can see we've had just consistent upward wedges. And these other things, these mean other things at different times, but we'll focus on the wedges because we've got a big one right here that's forming. So notice that before the market topped on a 20% decline back here in 2018, we had a wedge that broke lower. We had a wedge that broke lower here for a bit, lower here a bunch, in that 35% decline. From February to March, and then we've got one forming here. Down here is volume. So again, I just talked about how big volume, means conviction, low volume means lack of conviction. So you square that with the direction. The yellow line is a 10-day moving average. So I was watching this very closely as it got close to or below that line. It was interesting because we started to see things begin to get shaken up in the market. So where we were seeing that was it peaks or at short-term tops, if you will? Not every time. You'll see I tried to draw a circle. Maybe I missed one right in here, where this line was touching or going below. And if you drew an arrow or if we drew a straight line up, you can see right here, we got a little weakness as that began to develop. We got a lot back up in here. We got a pretty good decline here. We got nothing here. Market kept going up as this bottomed and so forth. Right in here, we had some, just nothing but, just increased volatility. And then, boom, we had the big sell-off, upward sloping wedge, and we touched it there. This has been relatively safely above this line until right about now. We're just about touching it again against this upward sloping wedge. So what does that mean? Lack of volume, and you can see the daily bars are falling. There's definitely some space below here, and that's where we kind of get to before we get into a little trouble. So from a volume perspective, what it says is, as does the wedge, is that number one, we're losing momentum up here. Doesn't feel like it necessarily, but we are. And number two, we're losing it on low volume, which means lack of conviction. The moving average convergence divergence, I just talked about that on individual securities. Here it is. Those of you who've been with me on the videos last few years, this will look very familiar. So when you have an upward sloping wedge and you have a MACD, which is declining, this is one of your most respected momentum signals here. And you can see I could have drawn a lower line here. So I look at the divergences, right? So here you have a uptrend, a higher high, but you have a lower high. That's called a bearish divergence. That against an upward sloping wedge technically is a bearish signal. And then you have the relative strength index, the RSI. So you can see similar patterns here. During breakdowns or just before breakdowns, an upward sloping wedge coupled with a bearish divergence in the RSI, tend to be signs of, if you're a trader, you might want to get defensive. Or if you're long-term investors like we are and you have good macro reasons to be defensive, the technicals are supporting your position right there. So folks, this is just a handful of a lot of the things we look at. My deep weekly dive that I do in both the macro and the fundamentals and the technicals. There are several technical indicators, like just where the S&P sits relative to the 200-day moving average as an index. The monthly Bollinger Bands indicator, which some of you will sound familiar because I've shown that from time to time. Weekly moving averages are beginning to look a little more constructive to me. But then you have other things like sector performance relative to the S&P, although lately that's been getting better too. But kind of a 50-50, maybe 60-40 mix from the bullish side on that longer-term weekly stuff. That says, that maybe there's something to this rally that in terms of sustainability. The macro analysis says no, absolutely not at this point. And that's what we stick to. Back in here, frankly, when this 20% decline, I did a ton of videos back in here. And the technicians turned bearish, some who I've had a lot of respect for and who I've learned a lot of this stuff from, actually got bearish in here. And we remained bullish the whole time. We actually thought we were gonna bounce off of here, or I did. And right in here is where we had a real disruption in the U.S.-China trade war. A lot of this was the Fed, and then that was kind of the icing on the cake. But we never got bearish and we never got defensive because our index was still scoring quite positively from a macro standpoint. And then we got up in here, and here is where we began getting, hedging and getting conservative. And then, of course, that paid off very well during this downdraft. Now the market is pretty much caught up with our portfolios. Now with the addition of commodities, we're kind of sloping with the market upwardly. So we like what's going on. More importantly, folks, and I keep reiterating this to you clients in our review meetings, I'm much more concerned with this right now. Yesterday, I looked back all the way to 1927 and I charted bear markets during recessions. And I've told a few of you that there hasn't been one since 1927 where during a recession, a bear market didn't come down and at least test the first decline. In many cases, it just blew right through it. Actually, I found one when I looked again. It was, I think, 1949. We had a recession in there, and we had just barely a bear market. A bear market, you go down 20%. I'll show that chart at a later date. But we came down, and we just hit bear market territory, and we came out of that, and we were fine after that. And we were in a recession. Every other recession since 1927 on my graph shows that we either came down and just touched it or just about touched that bottom, or blew right through it, with only one exception, when we had a bear market during a recession. So this absolutely could be the second time. I'll be surprised given the circumstances, but we have unprecedented stimulus at work, and we have a whole new army of retail investors who find themselves with a little extra cash, and they're trading on these cost-free platforms. And they are a real force in this market. And some days they're making up 25% of the volume. So that's reminiscent of the dot-com bubble in the late 90s. But, again, markets are dynamic, which keeps our job very interesting. One thing I can say with 100% certainty is the risk right here is exponential. So we're going to continue to play it defensively. Thank you, as always, for watching and listening. And I hope you have a wonderful evening. Take care.